I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is a bonus video on trading tight trading ranges on the open. Sometimes they last all day, and I will talk about that as well. The easiest type of day to trade is a day where there are no reversals on the open. You get a bull trend or a bear trend from the open, and sometimes it lasts all day. You get about one of those days a week. 80% of opens have at least two reversals, a double top, a wedge top, a double bottom, or a wedge bottom. Those are very important, but I'm not going to be talking about those today. Today I'm going to be talking about trading range opens where there are 5 or more reversals. Sometimes it lasts all day, sometimes it lasts for an hour or two. Finally, I'm going to be talking about a tight trading range open where there is no breakout, there is no trend, there is no swing trade. The tight trading range just continues all day. I want to begin by talking about days where there is no reversal on the open. You get a trend from the very first bar. Here's an example of a trend from the first bar that was a bull trend. About 20% of the days have a trend from the first bar that lasts all day, so it's about once a week. If you have a gap down and you have a bull bar and a possible bull trend from the open, traders will buy on a stop one tick above the high of a big bull bar closing on its high. And they'll continue to buy above bull bars closing near their highs all day long. And then late in the day, there's often some profit taking. If you get a bear bar, some kind of a wedge top, it's reasonable to exit your long at the end of the day. You do not take all of these entries, but it's important to take at least one. And if you get out and the bull trend from the open is continuing, look to buy again. And any of these are reasonable entries. Everybody likes this kind of a day because there are very few decisions. You know that it's going up, and the only choice you have is where to buy. There's a high probability of profit, and if you buy early, the profit can be very big, and you end up feeling like a professional trader. It's fun. This is a bear example of the same thing. A bear trend from the open. Strong bear trend. We have several bear bars closing on or near their lows. Once you have the first two bars with bear bodies and then one of them closing on or near its low, you got to be thinking about the possibility of a bear trend from the open, and traders will start to sell. It's reasonable to sell below the low of that second bear bar closing on its low and take a chance that you get a swing down. As long as the bear trend continues, you can take any of these shorts. Look for a bear bar closing below its midpoint, preferably near the low of the bar, and you simply place an order to go short one tick below the low of the bar. And you can do that all day long as the trend continues. %, of opens have at least two reversals. Here are examples of opens above the moving average, and the bulls look for the market to go sideways to down to get near the moving average, and they look for either a double bottom or a wedge bottom. The bears hope that there is a double top or a wedge top and then a swing down. 80% of days test support or resistance in the first 90 minutes. And if there's a reversal from that support or resistance, I call it an opening reversal. And the reversal often becomes the high or low of the day. Here, we reversed down on the open, it became the high of the day. Here, we reversed up from support, and it became the low of the day. As I said, bulls look to buy a wedge bottom or a double bottom near the moving average. And the bears look for a double top or a wedge top and hope that the market reverses down. If you have 2 to 4 reversals on the open, you're probably going to get one of these patterns: double top, double bottom, wedge top, wedge bottom. Here are examples where the open is below the moving average. The bears look for a double top or a wedge top near the moving average and then a swing down. The bulls hope for a wedge bottom or a double bottom and then a swing up. Trading range open. That's a term that I use when there are 5 or more reversals on the open. Here are some examples. Market sideways for an hour or two in all of these examples. These are examples above the moving average. Here there was a bull breakout. Here there was a bull breakout and it failed. Here there was a bear breakout, and here there was a bear breakout that failed. If you have 5 or more reversals and the range is tight, I call it a tight trading range open, or you could simply call it a trading range open. Here we have a lot of little reversals. We're up and we're down, we're up and we're down, and there were more than 5 reversals. That is a typical trading range open. Sometimes you'll get a pattern that is contracting, and it can be a triangle. But it does not matter what you call it. It's a breakout mode pattern. You're expecting a breakout. Whenever you have a breakout mode pattern, you have to accept that there's a 50% chance the breakout will be up, 50% chance it'll be down. In addition, you have to believe that the first breakout has only a 50% chance of success. 50% chance the breakout will fail. A bear breakout, it failed. A bull breakout, it failed. Here are some opens that are mostly below the moving average. A triangle, and we have a double top and a double bottom. Again, 5 or more reversals. Here we have a bear breakout that got a swing down. Here we have a failed bear breakout down here at the low, and it reversed up. We have a bull breakout that failed up here, we reversed down, and here we ultimately had a successful bull breakout. We had a breakout below the triangle that failed, but not a breakout below the entire range. So bull breakout, failed bull breakout, bear breakout, failed bear breakout. Again, 5 or more reversals, and it's sideways. It's a trading range open. You can call it a tight trading range open if it's fairly tight. Again, does not matter what you call it. All that matters is you realize it's breakout mode. 50% chance of a bull breakout, 50% chance of a bear breakout, and 50% chance the first breakout will fail and reverse. Many reversals here. We have a tight trading range, a lot of reversals. That is a typical trading range type of open. A lot of times you can tell within the first bar, or 2 or 3, that it's going to be a trading range open. The minimum you need for any trading range is a market going sideways with 2 or more reversals after the first bar. Here's the first bar. After the first bar, we reversed up, we reversed down. So that's already a trading range open. When the market's in a trading range, it typically has 2 to 4 reversals and it forms a double top or a double bottom or both. If it's only 2 to 4 reversals, I typically call it either a double top or a double bottom instead of a trading range open. Once it has 5 or more reversals, then I start referring to it as a trading range open. At this point, I would call it a double bottom. At this point, I'd call it a double top. So a double bottom, double top, it's a trading range, breakout mode. But once you start to get more reversals, I'll use the term trading range open. Here we have 3 legs up, 1, 2, 3. There's a wedge, there's an expanding triangle. There's a double bottom, there's a double top, It doesn't matter what you call it. You just have to recognize that you have 5 or more reversals in a tight range, and that tells you that it could last a long time. It could last a couple hours. It could even last all day. And do not get too eager to enter. We have an expanding triangle. We have a contracting triangle. If you want, you can call that a diamond pattern. Different computers focus on different patterns. Now, how long can a trading range open last? Sometimes it could be pretty brief, 5 to 10 bars, lots of little reversals. Every bar here it's reversing. Other times the trading range open lasts all day. When you have an open that looks like it's going to be a tight trading range open, you're hoping for a breakout. But until there is a breakout, there is no breakout. And traders bet on reversals and they take quick profits. They scalp. The tight trading range is the chart pattern, and the style of trading that you use if you're trading it is a limit order market type of trading. You're looking for limit order trades. Most traders should not do that. They should wait until the market converts from a trading range into a trend. Limit order market, if you're a limit order scalper, then you're constantly expecting attempts to form a trend to fail. Therefore, if there's a bull close, they'll sell the bull close. If there's a bear close, they'll buy the bear close. They're doing the exact opposite of what you would do if you were expecting a trend. Also, if the market breaks out below a prior low, they'll place a limit order to buy at that low. If it's starting to break out above a prior high, they'll place limit orders to sell at prior highs, betting that the breakouts will fail. They're betting on reversals. Here, they buy at that low. They'll buy at any low. They'll sell at any prior high. A limit order market, that means you're betting against a successful breakout and a trend. You're betting on continuation of the reversals and continuation of the trading range. Most traders will lose money if they trade a trading range open. Most traders will lose money if they trade any kind of a tight trading range, one, for example, that lasts all day. They should instead look for a stop order market, a market that is on the verge of trending or is clearly trending. If you're trading with stop orders, for example, buying above a bar, you're expecting the market to go higher. You're expecting a bull trend. If you're selling above a bar, you're betting on a reversal, a trading range type of market, a limit order market. Most traders should not trade that kind of a market. A lot of reversals inside a trading range. It's a trading range open. Most traders should be entering only with stop orders. Sometimes you're lucky. You'll get a decent buy signal bar near the bottom of the range for a buy. That is a reasonable stop entry buy. Otherwise, you can wait for a breakout and then look for pullbacks to buy above bull bars closing on or near their highs. Here are some examples. You don't simply buy above the first bull bar that you see. Here, you could buy above this bar, a double bottom. It might be okay, hoping for a double bottom, but then you get that, and you start to wonder, did you make a mistake? You have another bull bar here, but it has a prominent tail on top. And just because it's a bull bar at the bottom of the range does not make it a reasonable buy. That big tail is a sign that the bar is part of a trading range, and there might be more sellers than buyers above its high. Better to wait for a good-looking bull bar closing on or near its high at the bottom of the range for a buy, or a bear bar closing on or near its low at the top of the range for a sell, or you wait for the breakout. If you take this buy, we have a failed breakout below the range, it's reasonable to put a stop just below the low of that bar. It doesn't matter if you bought here or here or here, your stop is still at the bottom of the bull trend. We have a trading range open and a triangle. We have a bear bar. You might sell that. It's not a very big bear bar, but it's closing on or near its low. You have a second bear bar. Traders will start to be more aggressive with selling. 2 bear bars closing near their lows. 3, traders will start to sell below bear bars. Tight trading range, the market tried to reverse down a second time, and it's now trying to reverse down a third time, and you have a decent sell signal bar. It's reasonable to take that short. Or you could wait until the market has clearly broken below the bottom of the range, or wait until you have 3 or 4 consecutive bear bars and then start to short. It doesn't matter which of these shorts you take, you put your stop 1 tick above the top of the sell-off, which is right up here. Most traders should be looking for stop entries like these, and they should be swing trading. And by a swing trade, in the E-mini, I mean you're looking for a move that has 2 or more legs, and you're looking for a profit that is 4 points or more. And usually the trade will be 10 bars or more. And these are the kinds of trades that beginner traders should look for. They should look for swing trades, and they should look for stop entries. On an average day, they might have 1, 2, or 3 trades that are reasonable. Once a trader becomes consistently profitable, they can begin to take other setups as well, and they can add some scalps, and they can end up taking 3, 5, 10 trades a day. As you probably know, I have a classification of patterns for swing traders, my encyclopedia. There are 4 versions of every pattern. There's a buy, there's a sell, there's a failed buy and a failed sell, and I have about 100 basic patterns, 4 versions of each, so about 400 total sections to the encyclopedia. If a trader recognizes a pattern, he can look at examples of that pattern to get an idea of what might follow. Again, trading range open. You can often predict that an open is going to be a trading range open. For example, if the open is around yesterday's close, and if yesterday finished with small bars, prominent tails, and sideways trading, that increases the chances that today's open will be a trading range open. There are lots of things you can look for to tell you if the market might be in a trading range open. And if it is, you have to be patient. Sometimes you have to wait a couple hours before you find a reasonable stop entry trade. If the first bar is not particularly big, if most of the bars mostly overlap the prior bars, if the bodies are small and the tails are pretty prominent, if you have reversals every bar or 2, down, up, and down, up, those are all signs that the market is in a tight trading range open. If you see buy signal bars, but the buy signal bar does not look quite good. For example, here's an outside up bar, but a big tail on top. Here's a big bull bar, but it's forcing you to buy at the top of a tight trading range. Bears, they have a big bear bar closing on its low, but a fairly prominent tail at the bottom of a tight trading range. Selling below the low of that bar right here, probably not all that good. If you have big trend bars and they reverse on the next bar, big bull bar, then a bear bar, big bear bar, and then a bull bar, that is a 2-bar reversal. On the next higher time frame chart, it would be simply a tail. So on a 10-minute chart, this would be a tail, just like this is a tail. So down and up. If you see double tops and double bottoms, wedge tops and wedge bottoms, and the signal bars are not very good. If you see 5 or more reversals and the range is fairly tight and sideways, those are all signs of a trading range open, and better to be very patient. Or if you're an experienced trader, you can trade them with limit orders. A lack of a clear, sustained trend. 3 bull bars, but the bodies are shrinking. 2 bear bars, but the bodies shrank, and the next bar is a bull bar. If there are no consecutive big bull trend bars closing on their highs, or consecutive big bear bars closing on their lows, probable trading range open. If the bulls and bears repeatedly are alternating control, bull bars and bear bars, if most of the bars overlap one another, which is a sign that the bulls and bears agree that the price is fair, and therefore there's no urgency to make the market go up or down. Again, reversals every few bars, prominent tails. A tail is a reversal within a bar. A tail on the top of the bar means the market went up and went down. A tail on the bottom of the bar means the market went down and it went up. Trading range type of price action, reversals. Whenever the market's in a trading range, it's always better to buy low, sell high, and take quick profits, scalp. But beginners should be patient and wait for stop entry setups, trending type of price action instead of trading range price action. It can be really difficult to wait because tight trading ranges can be boring and they can last a long time. Again, if the market is trending, it's a lot easier, it's more profitable, it's more fun, it's more exciting, but you have to trade the market that is in front of you and not the market that you hope it becomes. It's really easy for a beginning trader to see a bull bar closing near its high, he buys it. A bear bar closing below its midpoint, near its low, he sells it. He can do that 3 or 4 times, and he can be so far in the red that he'll never make money for the rest of the day, and he'll feel terrible. He'll feel terrible for the next day. Do not be too eager to trade. If you recognize signs of a trading range open, be patient. Wait to see if you can get a small bull bar near the bottom to buy with a stop, or a small bear bar near the top that allows you to sell near the top of the range. The one thing you do not want to be doing is looking at trend bars at the top and bottom and betting on a breakout. So you do not sell below a big bear bar near the low, and you do not buy above a big bull bar near the top. Remember, you want to buy low, not sell low. You want to sell high, not buy high. Different ways to draw lines. One is possible trend line across the top. Another is a line across that high. In either case, we have a double bottom at the moving average after a gap up, good for the bulls. We have a buy signal bar here, but not very good. A better one here. This is a reasonable stop entry buy. And then we have this, a very big bull bar closing on its high, closing far above the high of the bear bar, closing above that high as well. It's closing above the tops of 8 consecutive bars, and it's breaking above a bull trend line. This is a trend type of bar. It's an indication that the tight trading range might be ending, and we might be beginning a bull trend. Here, I said I would not buy above that bull doji, but now we're at the moving average, and we have a bull bar closing near its low toward the bottom of the range, if you want to call it a triangle. That's a reasonable stop entry buy. Higher probability, you wait to see consecutive bull bars closing on or near their highs. And then you simply start buying above bull bars. Here, buy above a bull bar closing near its high, that, possibly even that as well. Never worry about missing the earliest entry. If you get a breakout that's reasonably strong, the odds are the market will go at least a little bit higher. Whenever you have a lot of sideways trading, the market is in agreement. It thinks the price is fair. That reduces the chances of a big trend day up or down. And therefore, if you get a strong breakout like this, it may not lead to a bull trend. It probably will have some follow through, but not necessarily a bull trend. So a lot of early trading range trading reduces the chances that the day will be a big trend day. And you can see the bulls got some follow through here. They got a second leg up here, but that was it. Then the market was sideways. Again, stop entry, not very good, but you have a second buy signal bar closing on its high, bigger body, and a reversal up from the moving average. Sometimes you get a third entry as well, but a second entry, especially with a better looking buy signal bar, is a higher probability stop entry buy. Higher probability, after you see a pair of big bull bars closing on their highs, you can buy high probability. Risk is bigger because your stop is further below, but the probability of making money is greater, and it's a good setup for traders to buy. High probability trades are always good. Higher probability, you wait for the breakout, you wait for the follow through. Yes, the risk is bigger, but you have a much better chance of making money if you buy after you see the two bull bars. If you have a trading range open or any kind of a setup, a bear trend, and then you see a pair of big bull bars like this closing on their highs, consecutive bull bars closing on their highs, if you're short, you have to get out. And if you're flat, it's reasonable to get long. And the opposite is true if you're in a trading range or a bull trend, and then you get a couple big bear bars closing on their lows. On this breakout, you can either buy the close of the bar. Right when the bar closes, you hit buy the market. Right before the bar closes, you hit buy the market. Or you can buy with a stop, one tick above the high of the bar. Different ways to draw lines: bull trend line, very tight bull channel, and then possibly the bottom of an upper trading range. Here's a lower trading range. Consecutive big bear bars, here we have 3, but after you've had 2 consecutive big bear bars closing on or near their lows, especially if the closes are below support, like the bottom of this trading range, the bull trend line, this bull trend line, you have to get out of longs if you're still long, and you have to be thinking about shorting because you're probably going to get follow-through selling. If you're long, let's say you're still long from this and you get that, you get out. If you're flat, reasonable to get short. This bar closed below the low of about 20 bars. It closed below this bull trend line and below that bull trend line. We're probably going to have at least a small second leg down. The breakout grew one more bar, pull back, second leg down. Closed below these lows and below the low of the past 25 bars, consecutive bear bars closing on their lows. High probability that we're going at least a little bit lower, so reasonable to get short. Trading range open, lots of small bars, prominent tails, a lot of overlapping bars. Breakout mode. Do you want to buy this? Well, you got 3 bear bars here, 2 other bear bars here, probably not a good stop entry buy. Do you want to be buying up here? Well, the rally is not all that strong, and it could be a 50% pullback from the sell-off. So not good stop entry buying. Do you want to sell below this bull bar? No, you got 4 bull bars, you're not going to take that sell, and you don't want to sell below a bear doji, low probability. So you just patiently wait. We have a weak sell signal bar, fairly prominent tail and a small body. Higher probability to wait for some kind of a breakout. Here we have a small breakout, not below the entire range, but look to the left. It's a breakout below all of these bars, and it's closing below all of those bars as well. And the next bar has a bear body, so that is a follow-through bar. The market's always in short, and probably it'll go at least a little lower. Here it went a lot lower. This bar closed below the low of the past 12 bars, and it had a follow-through bar. Some traders will sell the close of that bar or sell below its low. Others will wait for the close of the follow-through bar. If it has a bear body, they'll sell the close of that bar. A lot of trading range trading for the first 20 bars today. It reduces the chances that today is going to be a big trend day up or down. And if you get a breakout, it probably will not lead to a bear trend that will last all day. You'll probably end up with a lot more trading range trading later in the day. Bear breakout, bear follow through, and then now we have a couple more bear bars closing on or near their lows. It's reasonable to sell below any of these bear bars looking for a swing down. You get a bull bar here closing near its high. If you're short for any reason, you get out above that bull bar. I want to talk a little bit now about how a limit order trader will trade a trading range open and a trading range open that lasts all day, a trading range day. Here's an example, trading range open, and it just kept in the trading range all day. Whenever you have a lot of early trading range trading, big tails, reversals, you're probably not going to get a swing. So if the first 5 to 10 bars look like that, it's usually better to go for a scalp. The bars in the first hour are normally big enough, and the moves in the first hour are normally big enough to scalp for 2 points. So for example, we have a reversal up, a big bull bar. We have an attempt to reverse down. It triggered, and then we reverse up a second time. It's reasonable to buy above that bull bar, one tick above that bull bar. But with all of the trading range open from yesterday and then today, it's probably not going to be the start of a bull trend. But the bars are big enough, and there's enough room to the moving average to buy above that and look for maybe a 2-point scalp. So you can place a limit order to take profits about 2 points above your entry. And the bears can do the same thing. We're getting a reversal down from the moving average, and we've had 3 reversals down today. 1 and 2 and 3. It doesn't look like a wedge, but it's a wedge. You can also say we're up here, we're down here. Up here, down here, up here, down here. So parabolic wedge, 1, 2, 3. A bear bar closing near its low. Reasonable to take that short, but it's probably a trading range open, not the start of a bear trend, especially with several pretty good bull bars. If you take the short, you're probably going to go for a couple points profit. Place a limit order to buy back your shorts 2 points below your entry price. After the first hour, when the bars start to get smaller, if you're still looking for scalps, it's better to switch to 1-point scalps. Here we have consecutive inside bars and a pretty good rally. We're probably going up at least a little bit more. It's reasonable to switch to a 1-point scalp. So if you buy with a stop above the II bull flag, you place a limit order to get out about 1 point higher. And you get out there. This is not the kind of trading that most traders should be doing. If you have a lot of trading range trading, buying with a stop at the top of the trading range right at the moving average, not an ideal thing to do as a scalper. But an experienced scalper who's willing to use wide stops, maybe down here or down here, and who's willing to scale in, can take that kind of a trade. Scalpers, if you're taking this buy, your stop is down here. If you're going for a 1-point scalp, your risk is many times greater than your reward. And that's why most traders should not take this kind of a trade. If you're going for reward that is very small, you need very high probability to trade it successfully. To get that high probability, you have to be willing to scale in and use wide stops. And most traders cannot do that. So most traders should not buy this for a scalp. They might buy that for a swing, but I would not. You're right at the moving average. We have a lot of reversals. It's probably a trading range day, and you're buying near the top. Not a good swing trade for most traders, and most traders should not be scalping, especially at the top of a tight trading range open, and therefore most traders should not take that buy. If you are looking for stop entries and you have a trading range open, possible trading range day, there usually are about 5 or 10 opportunities for stop entries. Buy above that, sell below that. I think that's less good to be buying that high up, but selling below that near the top of the range makes sense. Try to buy a reversal up here from the bottom of the range, buy a reversal up here. A typical day, even if it's a tight trading range day, you'll have 5 to 10 stop entry setups for scalps. Limit order traders, on the other hand, love days like this. It's a trading range day, tight trading range day. Far easier to make money with limit orders and far more setups. Very hard to do. Most traders should never do it because they'll make too many mistakes. But if you're a consistently profitable trader and you have the emotional makeup that allows you to buy as the market's falling, use a wide stop and scale in, sell as the market is rallying and use a wide stop and scale in, then you can do pretty well on a day like this. For limit order traders, there are usually 20 or more signals in a trading range day. And I want to concentrate on 3. You want to fade bad flags near the top or the bottom. By fade, I mean do the opposite. If there's a bad bull flag at the top, you sell it. If there's a bad bear flag near the bottom, you buy it. You want to fade big bull bars near the top and big bear bars near the bottom. If there's a big bull bar near the top, you have to bet the breakout will fail. You're looking to sell. If there's a big bear bar near the bottom, you have to bet that the bear breakout attempt will fail, and you have to look to buy, fade the move. And then finally, you fade breakouts of prior swing highs and swing lows. If the market goes below a prior low, you look to buy it. If it goes above a prior high, you look to sell, use a wide stop, and scale in. First, I want to talk about fading big trend bars at the top and bottom. A very big bull trend bar with a lot of trading range trading. It makes more sense to sell the close of the bar, just sell at the market as soon as you see a big bull bar closing on or near the moving average, a little bit below, a little bit above. You just sell every big bull bar near the moving average. You use a wide stop and you scale in. So you sell this, you sell more here, and you look for a scalp. Opposite's true if you see a big bear bar near the bottom of the range. You start to buy closes of big bear bars, betting that you'll get a reversal. Buy the bear close, bet on the reversal. You can see there were lots of opportunities here to sell big bull bars at the top and buy the closes of big bear bars near the bottom. Next, it's good to fade prior highs and lows. Again, much better if you can use a wide stop and scale in. When the market's going up, you place a limit order to sell at that high, use a wide stop and scale in if you have to. If it immediately goes down, you get your scalp. And the bears can do that with any prior high all day long. Here's a high, we sold off, place a limit order to sell at that high. Any of these highs, you can sell with a limit order, use a wide stop and scale in. That high, same thing. And you can do that all day long. The bulls will do the opposite. If the market's going down, they'll place limit orders to buy at a prior low, at that low, or this low, or that low. They'll buy there looking for a scalp, or this low, buy there, look for a scalp. Lots of opportunities to do that as well. And finally, you want to fade flags near the top and bottom, betting on reversals. Look for a bull flag near the top that doesn't look quite right, and then you sell above the bull flag instead of buying it. And then you look for a bad-looking bear flag at the bottom, and you buy below it instead of selling. You're betting on a reversal. Here's a bull flag at the top, a bear bar, a doji bar, not a strong buy, so bears will sell with a limit order at the high of that bar, and they'll sell more higher, and then when it comes down far enough for a scalp, they'll take their profit. A doji bar, not a very good buy signal bar. A bear bar, not a good buy signal bar. A doji bar near the top of the range, not a good buy signal bar. Traders will place a limit order to sell its high and then wait for a 1-point move down and scalp out. Here we're near the bottom of the range and the market has a bull inside bar, so it's a low one sell signal bar, a bear flag. It's a bad looking sell signal bar at the bottom of a trading range. Bulls will place a limit order to buy at the low of that bar, and they'll get filled here, betting that the market will soon reverse up and they can make a scalp. Another bull bar, a bad bear flag near the bottom of the range, same with this. Here, you have a big bear bar, but it's following an even bigger bull bar, so you'll get bulls willing to buy at the low of that bar, betting the bear reversal will fail. And you can see lots of opportunities to do that as well. If you just look at this chart at the end of the day, you'll say, wow, there wasn't much to do. But if you look at all the little things that I talked about today, in fact, there were many opportunities for limit order scalpers. In a limit order market like this, a trading range open and it just remains a trading range all day, nothing looks good enough. But if you're organized and you go in with a plan, betting on reversals, and you're able to trade limit orders, there are many, many opportunities to make money. Remember, markets have inertia. They resist change. When a market's in a bull trend, it's going to resist a reversal down into a bear trend. If it's in a bear trend, it's going to resist every reversal attempt and it will continue lower. But when it's in a tight trading range, it'll also resist attempts to break into a trend. If you're going to trade a day like this, yes, it's fine to take stop order entries, and in fact, most traders should only take the stop order entries. But limit order traders love days like this. There are many, many opportunities to make money. I'm going to show you now all the trades that I have been showing over the past several slides to demonstrate that, in fact, if you are a limit order scalper on a day like this, there are usually 30 or 40 opportunities to make money, and that's 1 point per trade. So if you're an aggressive trader, theoretically you can make 30 or 40 points on a day that looks like there's nothing to do for most traders. In general, pretty much any setup, stop entry setup, limit order setup, will have between a 40 to 60% chance of success. If you can use wide stops and scale in and trade with limit orders, you can make that probability quite a bit higher. And that's how limit order scalpers trade in days like this. They use the wide stops, they scale in, and they're confident that the market will resist breaking into a trend. So they're constantly betting that every attempt to sell off will fail, so they're looking to buy, and every attempt to become a bull trend will fail, and they look to sell. I began by talking about a trend from the first bar. They happen about 20% of the time, and you trade them like a trend. You constantly look for trades in the direction of the trend. I then talked about how 80% of opens have at least two reversals, either a double top, a double bottom, or a wedge bottom. And then the focus of my talk today was on trading range opens, a trading range where there are 5 or more reversals. Most traders should patiently wait for a good bull bar near the bottom and buy with a stop above its high, or a good bear bar near the top and sell with a stop below its low, or wait for a strong breakout and then trade in the direction of the breakout. If the breakout fails, you trade in the opposite direction. Sometimes the trading range open will last all day and you continue to trade it like a trading range open all day if you are a limit order trader. There usually will be 5 to 10 stop order scalps as well, but if you're a limit order trader, you can do extremely well betting that every attempt to rally will reverse down. Every attempt to convert into a bear trend, break into a bear trend, will reverse up. I'm Al Brooks. Thank you for watching this bonus video. I talked today about trading tight trading ranges on the open and tight trading ranges that last all day.